Welcome to Daily Wisdom from the Flippening podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor.
Hi, I'm Michael Kaplan, editor of the Flippening podcast. Today's episode is from a 2018 conversation with Ateet Ahluwalia, managing director at CoVenture Crypto, a cryptocurrency asset management firm. We discuss why developed countries will be last to adopt crypto and why Bitcoin is a cheap or accessible form of trust. For the full conversation, check out Flippening episode 15. And now, without further ado, our conversation with Ateet Ahluwalia, managing director at CoVenture Crypto. Enjoy.
When I was carefully going through why I had messed up something that I had historically always made money on, which is like turmoil in the macro markets, how could I not make money this time? Like, why was I flat on this trade? And when I went through, I actually saw Bitcoin had some correlation to the Cypriot crisis where they haircut bank deposits. And I'm like, oh my God, people actually, when times are tough and they have no other option, they will put money into this video game token, no pun intended, and they will actually use it as a vehicle to maintain savings when the government has failed them. And that sparked my curiosity enough to start looking into it. But it really wasn't until I got a real detailed look on Bitcoin from one of my buddies who's frankly just magnitude smarter than I am. And he really broke it down for me. And he said two words that just blew my mind. He said cheap trust. And given my background and my history, the notion of trust is so critical in every form of relationship, financial, interpersonal, whatever it is. Like when he said cheap trust, that's when I really got involved, especially on the back of the Cyprus bailout.
I have this hypothesis that the people who are going to get into crypto assets last are going to be poor people in the middle class in developed countries because they've always been able to rely on their currencies. Whereas in places like Zimbabwe, Venezuela, Cyprus, Argentina, they have distrusted their fiat currencies for a long time and got involved fairly early. Have you seen in general as a macro investor, have you noticed that generally when these fiat currencies collapse, that there is a flight to crypto assets and Bitcoin in particular?
Well, definitely. And you can see that like in the Argentina case, the Zimbabwe case, in the Venezuela case, you can see that just on the price chart. If you just look at the lead lag relationship there, that's definitely a viable relationship. And if you actually think about why, I agree with your statement. First of all, I think the middle class in developed markets is the last to the party. I'd say I think I read 4 to 6 stories on Bloomberg every single day about cryptocurrency. And that's obviously a US geared audience on the Bloomberg US site. And only 8% of Americans own Bitcoin. And I think over 90% of them have $500 or less in Bitcoin. They haven't spread their wings, so to speak, amongst the other cryptocurrencies. They're not really in favor. So the media coverage is disproportionate to what's actually going on under the surface. And I agree with you that it's almost like a lack of knowledge that causes this issue. So it's in the headlines and it's pitched by media as something inherently untrustworthy, which is ironic to the nth degree. But because of that, not very many people are getting in on it. But if they actually went back in time and looked at the U.S. history, we've defaulted twice on our debt in the last 100 years. I mean, look, when Roosevelt basically confiscated gold from people, the fine was prison time or $10,000 if an IRS agent wasn't able to march you up to your safety deposit box and confiscate your gold in exchange for U.S. dollars. Now, then 6 months later, what do? They devalue the currency by 50%. i.e. you lost 50% of your savings. That is a default, right? However you want to color that. In 1971, when Nixon cuts the US dollar from the gold window because we were bleeding reserves due to a deficit, it's like, look, Europeans, we just don't want to pay you anymore. So we're detached. We're detethered from gold. It's not something we're going to do anymore. That, in effect, is a default as well. And that actually is an interesting segue to another side point. People talk about cryptocurrency not being a real currency due to the volatility. Well, if you compare the volatility of cryptos to say the US dollar and gold in the 1970s, once we had detethered from the gold standard, well, yeah, that's exactly the same kind of volatility you're experiencing now, right? So it's a lack of education on the behalf of developed market middle class investors, which is a deeper issue. Like, look, we don't teach financial savviness in elementary schools or high schools, right? It's only at the college, university, sort of the elite level that people can get involved in. And because we don't do that, people don't see how viable this asset class is, but just how important it is, because a lot of people in the middle and lower classes just have been steadily chipped away at by policies that are in place for the last, call it 30, 40 years.
What strikes me about the way that you view the world, or at least how I perceive you viewing the world, is that as a quantitative trader with a background in macro, it's almost like you coexist at two opposite ends of the spectrum. From the macro perspective, you're tracking global trends that are happening, how governments are responding to crises, how the world is changing. And at the same time, you're watching it all happen in a very operationalized way on charts and watching this stuff play out in a very numerical fashion. Do you think that's how you've always been, or is that a function of your training?
I think that's how I've always been, because like, look, since we detached from the gold standard, we're not a commodity-based economy, right? So frankly, it's all just a number on a screen. That's like one of my mottos when it comes to trading. And if I think of it as just a number on the screen, it's not being disrespectful. What it is it forces me to look at something objectively and then do scenario analysis that's ridiculous.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username Nomics Finance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.